call the meeting to order?
That's fine.
You're fine,
Yes,
okay.
ma'am. Yeah.
All right, being that it is 9:31, and we do have a quorum, we'll go ahead and call the meeting to order. I think everybody should have an agenda before you for the meeting, and is there a motion to adopt the proposed agenda as presented?
I move.
Is there a second?
Second.
All in favor?
Aye.
Okay, the ayes have it. And we'll go through approval. We have of minutes. We actually have two sets of minutes, one from the April meeting and then one from the short May meeting. And I was going to go with ask them as a package. Is there, unless we have discussion on them, but would there be a motion to approve the minutes for both the April 12th meeting and the May 17th meeting as presented?
So moved.
In a second?
Second.
Any discussion on the minutes? All in favor?
Aye.
Okay, ayes have it. Okay, and next, on to the chair's report. So I think we have two items, and they all have to do with the election of representatives. The first being the election of the retiree representative, which would be Dr. Wilder. And he has multiple times said that he would like me to excuse him from the room so we can discuss him and his pros and cons and see if we were interested in still electing him. And I'm happy to do that if anybody would like to have a discussion about him. If there would be a motion, do we need motions for these, or because they were presented at the
Yeah,
last meeting, we don't?
I believe there's a pending motion.
pending
so
motion.
You could just call for any discussion and then
So
call
is
the
there any
question.
discussion, or would we like to have discussion on this?
Madam Chair, Mr. Condon raised the question just now, do we have a quorum?
We do.
We do, yes. We have 4 voting members, yes. So, do we have any further, would you like to have the discussion on this, or would we like to call a vote?
I'd call a vote.
Okay, all right, then all in favor of approving Dr. Ron Wilder as a retiree representative signify by saying aye.
Aye.
Aye. Any opposed? Apparently not. So there would, I would like to say that I appreciate you being so willing to step out of the room. However, your service is so wonderful and valuable to the commission, and we're very, very appreciative of everything that you've devoted over the 5 years. And I can't tell you how delighted we are that you will be staying on for another term.
Well, thank you very much, and thank the commissioners for giving me the opportunity to serve another term. Look forward to it.
But as do we, as do we. All right, the next order of business is the election of the chair and vice chair for the coming 2 years. Currently, there's a motion pending to elect Dr. Ron Wilder to serve as the chair and myself to serve as the vice chair. It commences July 1st of this year and ends June 30th of 2 years, 2020, 2 years later. Again, is there any discussion on this matter, or would we like to call the vote as well? In that case, if they're all in favor of having Dr. Ron Wilder serve as chair and me as your vice chair, please signify by saying aye.
Aye.
Okay, I think,
Guys, have it.
phew, that was a tough one.
Yeah, that was.
Let me just say, I want to thank you, Rebecca, for your leadership over the last 2 years, and forward to the commissioners serving together to do our best for the beneficiaries of Sherry's fund.
Thank you, and we look forward to your leadership.
Congratulations.
And Alan, you're coming at the perfect time for your committee report. But, if you'd like. No, I mean, it was like impeccable timing, so, would you like to do the audit committee report, or I can skip over you and come back to you?
No,
Give you
I
a few
can
minutes.
do it here.
Okay.
I got my cheat sheet. Audit committee met on June 7th. We received the compliance update. On a variety of routine compliance matters. There were no exceptions to report. Internal audit, we received updates on the agreed upon procedures. With State Auditor's Office completed the report on cash receipts, disbursements, payroll, non-payroll, and had no findings. a GIPS compliance vendor was selected. That's, I can announce that, right? Okay. I just wanted to confirm that it's contracted, right? ACA has begun the work on the GIPS compliance verification process, and I believe the first state pension that got GIPS compliance is done now. Is that right? Is that one of the California systems?
There's a couple that have been doing it for
Yeah.
a few years, and CalPERS recently has announced it as
Right, and then we received a fiduciary performance review, or actually that started, that's a audit that's now a part of our statute. So, and I believe Funston is doing that, so work on that has started. And they'll begin, doing their interviews, and they've been doing, their preliminary work, but I believe they'll be on site doing in-person interviews this month. Starting Monday. And then we received an ERM update, and on the ERM framework, development process. So that is the report of the audit committee from our June 7th meeting.
I have a question. Is there, and I don't, when did they interview us, the commissioners? And is there, do they have a, might be useful for me at least, if they had a checklist, give me some, prompt some thoughts to prepare for the meeting in advance.
Absolutely. And, have you ever seen a copy of the prior report? When they
Yes,
did the,
yes, about 3 or 4 years ago?
yeah, do you need an updated copy of that? Because I'm sure a lot of their questions will be follow-up to
Yeah,
those
you're right.
items. And then, now I believe it's a little more narrow of a scope than the past one, right? Is Brad here? I can't see. Do you want to maybe give an update since you've talked with them?
So they're gonna be on site next week doing the interviews with the staff here, and they've provided agendas and topics of what they wanna cover for each individual person. The next phase will be meeting with commissioners, and the next level of interviews. That will take place after they have the interviews with us and they have more time to digest that information. So you
Okay.
guys are on the list. It will be later on, and I would expect that they will provide, topics for those interviews as well.
Like, for all of us that are having to do, that they're interviewing, like individually, they gave us a list ahead of time of the topics that they want to cover. And so you'll have time to look at it and prepare for the interview.
Okay, very good.
Yeah.
Thank you.
Any other questions for Alan? If not, I think next is the CEO report. Mr. Hitchcock.
Thank you, Madam Chair. Before I get started, Madam Chair, I would just like to echo the comments of our Chair-elect and just compliment you on your service over the past 2 years. I think when you and Mr. Giobbe were serving as the chair and vice chair, I think, you laid out a foundation of change for the organization that once you took over, you certainly took us very far in that transition from where we were to where we are now, which I think is significantly improved. And I think a lot of that is to do to the way that you've approached your position and through your leadership. And on behalf of the staff, I'd certainly like to express our thanks to you for everything that you've done and all the time that you've invested. A lot of folks don't see they're not there for the chair and the every 2 weeks chair and vice chair calls and get the kind of the ad hoc calls and all the time that you're here that that whether it's dealing with me or the Makita or there's a lot more that goes into it, that goes on behind the scenes that a lot of people don't know, and it requires a great deal of additional time for both the chair and the vice chair. But I would just like to thank you for all of your service to us over the past 2 years, and look forward to continuing to working with you in your capacity as vice chair, and certainly look forward to Dr. Wilder to working with you as you assume the mantle of leadership for the commission. So thank you. Just wanted to just express those thanks on behalf of the organization.
Thank
you. I have two things to report on, and one of those, the first one is kind of talking about the SIOP or giving an update on the SIOP and the AIP. And I'm not really asking for any, I guess, more of a consensus of the commission on that this is a the direction the appropriate direction or the appropriate way for us to be approaching kind of these two documents that we're statutorily required, or two plans that we're statutorily required to have. But really, I think trying to bring somewhat of a little bit more of a sense of order as to how we approach those statutorily required plans, and how we can hopefully make these documents a little bit more usable, and to a certain extent create a cadence by which we look at these plans and review these plans, and how I think can make it a little bit more strategic, both from a long-term basis regarding the SIOP and on a shorter-term basis on the AIP, and involve a little bit more strategic planning on the part of in conjunction with the staff and the commission. So, as I said, this is more laying out a vision. My plan would be for us to work with, in between now and September, for us the senior leadership of the staff to work with you and Dr. Wilder, and in developing some changes to the SIOP, and to try to maybe bring that document into a little bit more compliance with what the statutory requirement is, and also trying to make it a little bit more of a usable document. So, just to give you some background, the state law requires that we have both a statement of investment objectives and policies, and also that we have an annual investment plan. And we started touching on a little bit of this, I think, back when we had, at the last meeting in April, when we adopted the annual investment plan. And I think I previewed a little bit of this as to how should potentially think about looking at these plans, and how we would review and adopt them. As everyone knows, we recently approved the AIP, and the last time that we reaffirmed we're required to have an annual investment plan on an annual basis. And then we're required to, at least on an annual basis, change or reaffirm the SIO. And the last time that we did that was in September of last year. So we're within compliance in that regard. And the reason that it came up in September of last year is that's when we adopted the new delegation policy. And as part of that, we also reaffirmed the SIOP. I think now that we've, I think the commission can be a little bit more forward-looking in the way, rather than reactive, potentially shift into being a little bit more proactive. I think that there's an opportunity for us to turn these documents into a little bit more of a strategic vision for the organization, both on a long-term and a short-term basis. If we think about the SIOP, what I really think that we should be thinking about is that the SIOP's principal role should be to house the state mandated content, big picture, strategic and policy matters, and items that are relevant to the Commission's long-term asset allocation, and that the SIOP should demonstrate a much longer-term strategic view of the portfolio, and then the AIP. I think there's some state mandated content that's required to be in there, and ironically, that content, when you look at it, what's required is actually a little bit more permanent in nature. And interestingly enough, just to kind of show how that these two documents haven't necessarily kind of gone together, we've included a lot of the permanent content that's required to be in the AIP in the SIOP, and then have fulfilled that obligation by incorporating the SIOP back into the AIP. So it's a little bit of a kind of a convoluted way of getting at what we're required to do. And then we should also have the investment team's annual initiatives, and I think to Mr. Condon, I think most notably has brought up this point, also have a way of tracking that in a way of, because the AIP does require that that you monitor the progress of that. And I think we need to really look at the items in the AIP should be things that we can track, that we can monitor. There will be some, as far as the initiatives go, the key initiatives in the AIP, and that we think about is some of the to a certain extent, the ornaments that we have hung on that annual investment plan tree, do they really belong in the AIP, or is there more a strategic plan type document that those belong in? So just to give you an idea of how I would suggest that we go about looking at these documents and how that they would flow together. But before I get to that, there's also this, we're required to do an AIP, we're also required to do an SIOP, and then there's this somewhat amorphous requirement for the commission to provide both Jeff and I on an annual basis with your investment objectives. So the way that I kind of see that all flowing together is in the fall, we would review and approve the SIOP. I also think that would be a good time for us to think about looking at organizational strategic planning as well. I think some of that is, I think some of that has been to a certain extent delegated to me. But I think that having at least as far as the organization, if we think about staffing, budgetary needs, infrastructure, those types of things, I think it would be good for the commission to at least be informed of where we see those needs and how we see those things coming together on a little bit longer term basis. And I think we could incorporate that into that planning process for the SIOP. Then it'd be a good time to do that. And then, so you would think that would probably be somewhere around the September meeting, and then the later fall meeting, whether that's in late November or December. I think that would be a good time for the commission to then provide Jeff and I with the guidance on the investment objectives, what you would like to see as kind of the key initiatives in the AIP, so that then Jeff can go about working on the AIP, which we would look to provide a draft in February. Then in April, we would look to have the AIP approved because they're statutorily required to do one by May 1st. And then in June, we would begin the review of the SIOP again. And so I think that this is a kind of a good seasonal way of approaching these three requirements and a way for us to move forward and to make these documents flow together and also make them more usable and strategic in nature.
Any discussion on this? Questions?
Just, yeah, a couple of things. One, I just made a note for myself. I was going to tell some of y'all later, but might as well do it now. I think when the AIP was provided back in the spring, I didn't review it initially, and I kind of started reviewing it there close to the end. So part of that, well, that was my fault. But I just want to see if we can build in, since we're reevaluating, see if we can build in enough time to make sure everybody has enough time to review and make comments. And it might even make sense, and this would stretch it out longer, but might even make sense to have a draft, discuss it at a meeting, and then approve it at the following meeting. That way, you have a draft, you review it, you get input from other commissioners and staff, and then you go back and think about it again. Because these are the foundational documents that I think this commission, the 8 members here are kind of setting out to the agency, and they're critical documents.
And to that point, this comment, I think the way that I would perceive it is, there is this, there's SIOP, AIP, and then kind of in the middle, there's this requirement that you all provide us with guidance as to where, and we haven't, that kind of amorphous requirement, we've never really made that necessarily a priority. So the way that I see it is, that would be, a discussion that we would have at the last meeting of the calendar year. So that would be a regular standing item. And that would give, rather than only having the opportunity to kind of comment on the back end, that would give you the opportunity to provide some guidance on the front end before the plan's ever prepared. Then we bring you an annual investment plan in February. We review a draft, we review it with you, and then you would have opportunity to comment, and we would adopt it in April. So I think that would be right along with what you're talking about. And I think, the other thing too is I think that there's the one concern that I had, and I've expressed this before, about the way that the AIP is structured, the one thing that I want us to avoid is a sense that we have to kind of radically change the investment plan on an annual basis. I think we should be looking at the you know, when we think about asset allocation, I think that should be much more, the strategic long-term asset allocation is housed in the SIOP. We certainly review it every year, but I think we should really only think about changing it when we have conviction. And, you know, obviously there's been some, you know, there's flexibility within that with the ranges that we have around the various asset classes. But I think the AIP, I think, can be a little bit more of what's your kind of shorter term look, you know, those types of things. And what are we really trying to achieve over the next year that's achievable? And how do we monitor that? So I think, you know, hopefully this structure gives us the opportunity to give the priority to all of those things in a way that flows, then they kind of naturally flow together. So.
The second item was, and this dovetails into what we're going to discuss later in this communications policy, but, and I know that's not approved yet, but it talks about, and I'm paraphrasing heavily, you know, using simple language and,
Right.
you know, not get tied down in industry jargon. And a lot of that's going outside of the commission, but I think that's even useful, can be useful in these documents. So, and that might take a little bit more time to say something or explain something, but I think my point is just, we should consider that when we write these documents as well.
Sure. Yeah, I think that's, and, you know, what they're, you know, we certainly recognize that there's room for improvement on the way that they're not exactly the easiest reads.
Right.
So, yeah. Yeah. So we
Even
certainly-
for a commissioner, for sure.
Right, yeah, even for us, like on a daily basis, they're not necessarily, yeah, it's, but, you know, some of it is necessary, but I think we can certainly, that's a good criticism, that constructive criticism of what we need to focus on too, so.
Okay, thanks.
Okay. Next, and this is something that I will be asking for approval on, Madam Chair, is just to give you some background, when Funston was here last time, they recommended, one of the recommendations was that we adopt a communications plan. It's in our governance policy that we have, that the commission actually adopt a communications plan. For one reason or the other, I mean, we obviously have a wonderful external communications team with LaJoy and Kara, as the director of external communications and director of external policy, respectively. I think we've just never really dotted the I and crossed the T on actually bringing this forward and getting the commission to approve it. So this is something that is outstanding in regards to both from a governance policy perspective and a Funston recommendation. So that's why I'm bringing it forward to you, because, Funston is going to be on site, and we certainly want to comply with make sure that, or demonstrate compliance with as many of those recommendations as possible. And this also, kind of gave me an opportunity to go back and, again, a lot of what we've done, since I've been the CEO has been very reactive. We've reacted more, been much more reactive to situations, especially when it comes to how we communicate versus being proactive. And what I was trying to do was really synthesize down to a easy goal of our communications policy, which is, you see, is promote a sense of confidence that we are a world-class investment organization which performs solely in the best interest of the beneficiary's financial future. And that, then in doing this, in talking with you and Dr. Wilder, taking some of your guidance as to making this a little bit more general, and placing the majority of the responsibility on carrying out the communications plan on me, as well as my external relations team. Really just trying to identify what's our target audience, how should we approach that, and as Mr. Condon said, picked up on that, we think we should always communicate in a frank and open and honest manner, and that our messaging should be clear and concise, and we do believe that it should be, to the extent possible, investment jargon-free and easily understandable. We deal with very, to a certain extent, our job is simple. We're here to invest and manage the assets of the trust. So our mission is simple, or easily stated. However, the means by which we go about doing that has a great deal of complexity. So trying to really synthesize down what we do and make it easily digestible, I think it should be a main goal of how we communicate. We try to, also identify the methods by which we can communicate. I think we've seen over the past year, we've seen a vast improvement, most especially in our website. We've gone from the 90s to well into I would say into the almost right up to the present. So we've done an outstanding job, I think, there. But also, and as I said, as far as the responsibility goes, I wanted to lay out who's ultimately responsible, because with any type of plan like this, you need accountability. So most of that responsibility falls on me. However, I am blessed with, a fantastic staff in that regard. And, trying to lay out who's responsible for what, or make sure that the commission understands who's responsible for really kind of, the main and day-to-day interaction with which part of the audience that we're targeting. And I also thought that it would be important, so that there's accountability, and there's also the ability for the commission to weigh in and to understand what the focus is on a yearly basis, to require me to present you, the commission, with some yearly key initiatives that we'll try to achieve, or at least be part of the focus over the next year. And then I would suggest that we would, whenever those are presented whenever we would do this next year, that we would also review our progress on those. And we've done some of this as part of my annual review. I've made communications one of the sections in my annual review. But I think, it might be a little bit better to think of this as a kind of its own standalone item. So that's the plan. Hopefully everybody's had an opportunity to review it. I'll certainly be willing to answer any questions in regards to the plan itself, or any of the key initiatives, or if there's any additional key initiatives that the commission would like for me to have our communications team focus on. I'd be more than happy to do that as well.
I think the last two initiatives could turn out to be very important in the coming year. Of course, we don't know that in advance, but I'm just happy to see those on the list of key initiatives.
And Dr. Watt, I think I think the last one is probably certainly we want to make sure that if we're prepared and, to the extent that we can be a ready resource for the General Assembly as they look at pension reform. But I also think that regardless, I think it's important for us to do, or really to try to make the last one a priority. Because I think to a certain extent, providing that committee with as much education on what we do and how we do it, and most importantly, why we do it, is something that, and also with the kind of the first directive of making it as as kind of a jargon-free and as easily understandable as possible, I think should definitely be a priority. I think we've, to a certain extent, have operated a little bit in a vacuum in that regard, when it comes to asset allocation, and as we know, asset allocation is the biggest driver of risk and return. And I think that to the extent that we can bring a higher level of understanding to the people who are ultimately responsible for the plan, I think that will be helpful and gives them the opportunity to have some buy-in in that decision-making as well, so.
And that kind of education is always needed for just about everybody, because this stuff is difficult. I was reading a lot of minutes in preparation for this meeting, both RSIC and PEBA, and, when they were talking about, returns that did not meet the assumed rate of return in 15 and 16. Oh, and then people were making the statements, well, we need to bump up the contribution rates by another 0.5% to make up the shortfall in investments last year. And a lot of people could read that or hear that in a meeting and say, oh, well, the Investment Commission did something wrong,
Right.
but, people need to realize we're not going to get 7 1/4 every year.
Right.
And so it just goes a long way in that kind of investment or education process.
And have some further thoughts on that later to share with you as well, to some other ways that I think that we can approach that too.
Okay.
So. Okay.
I think this is excellent. I am delighted that you guys have put this together. You have assembled an excellent team, and they've been doing a fabulous job so far, and I think actually putting it in writing, what they've already been doing and setting forth initiatives going forward, I'm just very, very delighted with all of this work. Thank you very much.
Thank you, Madam Chair. And there is unless there's any other discussion, there is a motion to approve the plan.
Yes. So is there a motion to approve the communications plan as presented and authorize staff to finalize the plan by making any technical revisions or formatting edits consistent with the action taken by the commission?
So moved.
Second.
Second, okay. Any further discussion? All in favor?
Aye.
Any opposed? Nope. The ayes have it unanimously.
Thank you, Madam Chair, and that completes my report.
Okay, thank you. Next, the CIO's report. Mr. Berg.
Thank you, Madam Chair. I think David is going to need that next. I don't have much in the way of comments for you today at this time, other than I too would like to thank you for your service to the commission, for your help and support during the last 2 years. And I would like to share that really whenever Mike and I had any issue that we wanted to discuss with you, we always found you to be, and the phrase I would use is reflexively generous with your time. And you would always bring a perspective that's very valuable to us. So
You're kind. Thank you.
I speak not only for me and for Mike, but for the staff as well, a very appreciative staff, so thank you.
Thank you.
I am going to invite David King to walk us through performance for the fiscal year. Through April, as he will share, the plan was up almost exactly 8%. But as we sit here today, our closest estimate was, David,
Was
over 9.
9.5.
9.5%. So with a little bit of luck, we can reach double digits here in the back half of the month. But let me turn it over to David to walk us through the details.
Good morning.
Morning.
So today I'll go through our fiscal year-to-date performance through April 30th. So, and just as a reminder, typically we keep an abbreviated intra-quarter update, but because we had a little more lead time for this meeting, we've gone and worked up a full book. So fiscal year-to-date, the plan returned just a hair over 8% versus a policy benchmark of 7.3. So far through the fiscal year, we've paid $933 million in net benefit payments. Looking at that performance in dollar terms, you can see we started at $30.1 billion. We've paid out just under $1 billion in benefit payments. And through investment performance, we've raised the value of the trust fund about $1.5 billion, bringing us up to 31.5. Looking at our portfolio exposures, I just want to point out that these ranges now reflect what we adopted back in April. So just as a reminder, we adopted our next year's ranges in April so we can transition to our new asset allocation. All of our asset classes are within those ranges. Looking at our market value since RSIC's inception, you can see we're sitting towards the top of our end at $31.6 billion. Just from the last peak in 2007, we've added $2.1 billion to the trust. Since our inception, we've paid $12.2 billion in net benefit payments to retirees. Just looking at our fiscal year-to-date percentile peer ranking, you can see we're right at the 57th percentile. And kind of looking at that number on a rolling fiscal year and a rolling 1 year basis, you can see our fiscal year-to-date has been bouncing around the median. And our rolling 1 year is right at the 72nd percentile. looking at our asset class performance, you can see that most of our asset classes are still positive on an absolute basis, with the exception of core fixed income, public REITs, and infrastructure. I do want to call to your attention private equity. While it's our highest performing asset class, it is underperforming its benchmark significantly. Because we're looking in April, and because we have a lagged benchmark, just in the month of April, our benchmark returned 5.3%. The way private equity marks is on a quarterly basis, so a lot of marks haven't come in yet, so that inflates the underperformance in this specific period that we're looking at.
David, can you go back? I'm sorry.
Yes.
I can't see with clarity, but I know it's a large spread, the fiscal year-to-date return for private equity and the benchmark return.
So fiscal year-to-date, private equity returned 14.4%. The benchmark returned 23.1%.
Okay.
Why is that?
The benchmark is an 80-20 blend of Russell 3000 and MSCI EAFE, which have performed very strongly. We also had a 3% spread to that. And so we're looking at April performance, and this is picking up the month of January, which was just a very exceptionally strong month in markets. Looking at absolute performance on the x-axis and relative performance on the y-axis, you can see that, again, you can see private equity is our highest performing asset class on an absolute basis. Portable alpha hedge funds are our highest outperforming asset class on a relative basis. And you can see in the lagging behind our core fixed income and public real estate. And just looking at excess returns for all of our asset classes, you can see going down the list, hedge funds are at the top, followed by private real estate, public real estate. And when you take the plan,
Could you
Sure.
go back one? This is excess or
this is excess return over the policy benchmark.
the policy benchmark? Okay, thank you.
No problem. And taking the plan's excess return of 72 basis points and decomposing that by asset classes, we get to our attribution. So you can see that private real estate added 23 basis points to the plan's excess return. You can see private equity underperforming has detracted 55 basis points. And then looking at our portable alpha program, the collateral for that beta overlay has added 71 basis points of plan excess return. And looking at the same numbers, just in a visual, you can see them here. At this point, I'll pause for any questions.
Would you go back to the net benefit payment item back near the beginning? And my question is really about the end of the fiscal year where the big Terry payout will occur. Given that, are we still likely to see an increase in our ending value June 30th, given that lump that's going out around June 30th?
No. The plan value, which I wanted to separate that from performance. Cash flows into and out of the plan don't affect performance, but
Yeah.
we are expecting a several $100 million outflow at the end of the fiscal year, and whether or not that technically will be classified as affecting the June 30th, or if that will be something that happens in July, but effective June 30th, I don't have that precise detail, but there is a large one coming, and it is several $100 million. But as you recall, we have made provision for that. We are using 1% more cash in our plan, which will dovetail approximately with that last payment.
We also get a little bit of a mitigating benefit from the increased contributions that went into effect as well. So, there's an additional $220 million in, I think, in contributions that are, let's just call it $200 million in contributions that have come in that we wouldn't have ordinarily had this year too. So
And if it is interesting, we'd be happy to do sort of an ex post review of how the Terry program unwound, and we'd be happy to share that. I don't know that it would.
Once that is known, it would be very
Okay.
interesting to see that. And then that chapter in our history will be over.
Yes.
And it'll be good to move on from that.
Yes.
And
Yep.
look for a new world.
We'll do that. Any other questions for David?
we would, as far as like the, our performance with private equity relative to the benchmark, we would expect that to mitigate a little bit given, because, I mean, at this point, we already know what our benchmark return is going to be for
So-
the end of the year because of the lag, so.
So for the last 2 months of the fiscal year, so May and June, that the private equity benchmark will have a negative performance for those next 2 months, and by about 5.3%. So it'll end up just under 17.5% for the fiscal year to date. So that will come back.
The benchmark.
The benchmark,
Yes,
right.
the benchmark.
Right, yeah. And we'll get marks, we'll get,
Yes.
some marks at the end of this quarter as well, so.
Thank you, David.
Thank you.
Right. Madam Chair, I'd like to turn it over to Frank Benham from Makita to, before we get to investment recommendations, who will have a small cleanup item for us relating to the benchmark discussion that we had at the last meeting.
Excellent.
And I'm just as quickly going to hand it over to Aaron Lally, who you haven't seen in a few months. Aaron is, as many of you know, a new father and has now been able to get away and get a good night's sleep in the hotel room.
Yeah.
8 solid hours last night.
Wow.
So good morning, everybody.
Morning.
So our comments this morning will be relatively brief. If you recall, during the April Investment Commission meeting, performance benchmarks and asset class ranges were discussed. Today, we have two minor housekeeping items that relate to those discussions. So I wouldn't view these as changes per se, but more of a clarification to two items that were not formally addressed on the record previously. So the first is related to TIPS, so Treasury Inflation Protected Securities. This is an asset class, a new asset class for the Commission. You previously did not have a target to this asset class. When the benchmarks were discussed, this is considered kind of a sub-asset class under core bonds, so we did not address a benchmark for TIPS, but nearly every plan benchmarks TIPS against a TIPS index. So that is our recommendation that this commission follow. So the formal name is listed here, the Bloomberg Barclays U.S. Treasury Inflation Notes Total Return Index Value Unhedged USD. It's commonly referred to just the Barclays TIPS Index. The second item relates to equity options. This is an asset class that you've been invested in for a few years. So with the new asset allocation, we increased the target from 5 to 7, but we never formally addressed the fact that the range should also increase accordingly. So today we're recommending that a range of 5 to 9% be placed around the 7% target. So this is a slightly higher and slightly tighter range to what was previously in your plan documents. Any questions related to these two minor clarifications?
Just an option of, just a question about the option-based equity strategy, a background question. Is the historical risk of that investment much different than public equity?
I would say it's not much different, might be slightly lower.
Slightly lower. Thank you.
I might have missed it, but we don't need a range for tips?
It was previously approved, I believe.
We just didn't identify the benchmark?
Any other questions? If not, I do believe that there is a motion pending to adopt the recommendations of Makita to approve the asset allocation ranges and benchmark revisions recommended and set forth in red number page 49 of the open session materials. The effective ranges will be, or the ranges will be effective as of April 12th, 2018, and the benchmarks effective as of July 1st. And we direct that the approved asset allocation ranges be incorporated into and made part of the SIOP and authorize staff to finalize the benchmark and asset allocation ranges by making any technical revisions or formatting edits consistent with the action taken by the commission. Would anybody like to make that motion?
I move.
Do we have a second? Second, okay. All in favor? Aye. Any opposed? Okay, it's unanimously approved. Thank you very much.
I believe that's all we have for now.
Okay, excellent. Thank you very much, Mr. Benham. Mr. Berg, would you like to?
I'd love to, thank you. Could I get the clicker, please? So I do have a couple of comments ahead of, Ashley is going to walk us through our first private infrastructure investment here in just a moment, but I want to share a little bit of my perspective as someone who has spent a lot of time over the last couple of years thinking about the broader system, the health of the system, but more specifically, how investment decisions and returns interact with the health of the funded status, health and funded status of the whole system. It may seem strange in light of the fact that we're about to propose an investment where we expect a 7 to 8% net return, but I'm quite enthusiastic about this investment, which is by design supposed to be somewhat predictable and somewhat boring. But for a public pension fund, I would argue finding a stable and boring 7 to 8% return, we should regard that as actually rather exciting. What is most appealing to me about this is that investments like this will, generate a return that is, we assign a very high kind of utility function to, because we expect this to meet or even beat our actuarial assumed rate of return. But secondly, and this is something I've tried to illustrate on the bottom of the page, and believe it or not, in our world, on our computers, that was gold. So apologies for the unusual color choice there. But we're trying to make investments that can achieve that goal while simultaneously narrowing the range of outcomes down the road for our funded status. So this is represented, we're trying to represent this with the arrows suggesting we're bringing in the more extreme outcomes at the margin and trying to come up with solutions that help drive those returns, and all returns, frankly, toward that black line that it represents our expected return. So that's why I'm particularly interested in this. But one thing I want to make sure that we are all aware of is that this is an investment with an anticipated 20-year life. That's much longer than other things that we've considered before. There will be opportunities along the way for liquidity, but I don't want us to enter into this assuming that we have those available to us. I want us to assume that this is a 20-year investment. So infrastructure assets are typically very long-term, long-life assets, as are our liabilities. So I'm comfortable with this extended life, not only because of this symmetry, but also because we are anticipating a very significant share of that return coming to us in the form of cash yield that is distributed on an annual basis. So to me, that is a very meaningful and valuable mitigating factor to a characteristic of the fund that is certainly something we need to understand and needs to factor into our decision-making. So with that, are there any questions before I turn it to Ashley?
Jeff, what rate of return are you assuming on that investment?
7 to 8% net from the regulated infrastructure assets. If the manager, we'd like to believe, will generate additional return, excess return from their skill, but that's what we think that is a nice, safe kind of assumption for this investment. All right, I'll turn it over to Ashley.
Good morning. I am excited to be here today making the recommendation for our first private infrastructure investment. But before I do that, I thought it would be helpful to take a minute and remind everyone what infrastructure is, the role that it plays in the portfolio, and the benefit of owning regulated assets. So infrastructure includes the sectors that we see here: regulated utilities, transportation, midstream energy, and communications. The investment that we're going to talk about today invests exclusively in regulated utilities, which includes water and sewage, electricity and district heating, and gas distribution.
How about geography?
Well, there are these assets. You mean for this particular investment,
Yes,
or is this particular investment is European regulated utilities? And so what we really like about infrastructure, as Jeff said, is our characteristics, which we've outlined here. The high initial cost coupled with the essential nature of the assets mean that they generally operate in a monopolistic market and have inelastic demand. This inelastic demand leads to resilience through economic cycles. They have long-term, stable, and predictable cash flows that are governed by regulation or contracts that are linked to inflation or growth. And so these characteristics give the reliability of return that Jeff just discussed, which is very valuable to our portfolio. Here we dig in a little bit to that demand stability and return reliability by sector. We just saw that infrastructure is comprised of diverse sectors. Each of those sectors has its own return drivers that result in varied sensitivities to economic cycles, and that's plotted out on the bottom axis. If you see over to the far right with seaports, for example, it is intuitive, I think, that a port would see fewer volume of goods pass through in an economic downturn. Just as fewer items are purchased, there would be fewer items that are shipped through the port. If you move over, though, to the right with regulated utilities, a water or electric utility would have demand that would stay fairly stable through that cycle. People still, through a downturn, have the need for water and electricity even as the economy slows. So even within infrastructure, regulated utilities have greater demand stability, which leads to a greater reliability of returns than any of the other sectors, or many of the other sectors within the asset class, which makes a strategy that invests in these assets a really good foundation for our infrastructure portfolio.
Ashley,
Yes.
before we move on, forgive me, what are towers and what is midstream?
So midstream energy would be storage and pipeline for gas and for natural gas and oil. And then towers would be like the assets that we saw at the last meeting. They're cell towers.
Thank you.
Yeah. Yes.
That's just a question on the utility. In the public market, obviously, at the present time, utilities are out of favor and typically are interest rate sensitive. So do you have any concern over investing in utilities at this particular juncture, as because we are in a rising rate environment and historically at a relatively low point in interest rates, so over the, say, next 20 years, which is the investment spectrum for this, that we may be in a much higher interest rate environment? Would that adversely affect those investments?
So publicly traded utilities are valued a little bit differently than private utility investments. And so what you see is through the regulated return, which is comprised of a lot of factors, but one of them is the cost of debt. As that cost of debt increases, so does the regulated return. So you get a little bit of a different exposure than you would through those on the what you
Ed,
see
I
in the
think
private market.
we're gonna have a particular example that I think we can come back to that, and maybe it'll be a way of demonstrating it.
And if it's in the example, tell me, but, so this, you differentiate between private utilities and publicly traded utilities. So what we're buying, we're not buying an interest, or the fund we're gonna potentially invest in is not buying, are they buying an interest in publicly traded utilities?
No, they're
Okay,
actually
so these are-
purchasing
these are-
assets.
Okay.
So the utility assets from.
And so this fund would own 100% of those assets?
Not necessarily. These are very, very large assets. So you can imagine that it takes a lot of capital in order to purchase them. So what they do a lot of times, now this will, what they're trying to do is get a controlling stake so that they can affect changes and the management of the asset. But that doesn't mean 100% ownership. Sometimes that's a consortium ownership where Macquarie does try to take a lead role, or does take a lead role.
Okay, but there's no publicly traded security that
They,
that
if,
we're
so in
investing
the instance of like of a take private, they can buy shares, but only if the purpose of that is to turn those shares into a privately held asset.
Mr. Condon, we, separate from this investment, we do have investment in publicly traded securities that are of infrastructure nature. That
Right.
would include some of those types of examples that you referred to.
So are we good to move on? Okay. So we just discussed how regulated utilities have a lower sensitivity to economic cycles, which leads to a greater confidence in our return expectations. And now I want to dive a little bit into regulation and some of the other benefits regulated assets can have on the portfolio. So as background, the regulator has the singular goal of providing a necessary service to the community in the most efficient way possible. And since those services are critical to the functioning of the economy, the regulator sets a return that is high enough to incentivize proper investment of the asset, but not so high that the end user would suffer through the rates that are charged. And so through the regulated return, what the regulator is trying to do is mimic competition in what is a monopolistic market. This has the effect of limiting the return that an investor can earn, but it also provides protection against downside scenarios. So regulated utilities also have a mechanism for passing through changes in rates and inflation. This is done through the inflation linkage that rates to the rates that are charged to the end users, and also connected to the regulated return. And lastly, regulated utilities have a significant portion of their return coming in the form of cash distribution to investors. The prior slide outlined the benefit of having a regulated return. That is outlined on the slide by the first block here. This is the beta for these assets. The manager does have some levers for achieving outperformance versus this regulated return, and those are outlined here. The regulator sets a budget for what it believes it should cost to maintain and operate the asset. So to the extent that the manager can maintain the asset at a lower cost and create operational efficiencies that lead to lower operating costs, the manager can outperform the regulated return for those two segments. And we see that captured here by the first two boxes. As we continue to move to the right of the slide, if a manager can create a financing package with a cost of debt that is lower than the regulatory assumed cost of debt, this can also contribute to outperformance versus the regulated return. So as you can see, an effective manager can outperform the regulated return in a material way. And so with that background, I thought I'd pause here and see if anyone had any more questions. So moving into the recommendation, I'd like to make a recommendation for a 125 million euro commitment into Macquarie's Supercore Infrastructure Fund. The fund will make investments in European regulated utilities with a net return expectation of 7 to 8%, 5% of that coming from cash income. The management fee is 50 basis points on uninvested capital and no greater than 65 basis points on fund NAV. There is a performance fee of 20% of the yield over a 4% yield hurdle after all fees and expenses. The fund term is 20 years with two-year extensions, and investors can vote to extend beyond this initial 20-year term in 5-year increments.
When you say a 5% cash yield, are we expecting 5% in cash every year? Actually, a cash
Cash coming back.
distribution to us
Right.
every year?
That's the beauty of this
Yes.
type of investment.
Yeah, I was hoping that was the case. And I thought that's what I was told the other day, yeah. Okay.
Ashley, just
Yes.
going back for a moment to the performance fee of 20% over the yield. 20%, isn't that, I mean, is that considerably much higher than we would expect in most private equity investments? I mean, that sounds like a lot.
So this is a little bit of a different fee structure then. And so the fee structure here, the total drag should be about 85 basis points at this size. But this is not a 20% of all of the performance. This is 20% of the yield after we receive 4% of the yield. So we'll get our 4% of the cash income, and then everything after 4% is split, with 20% going in performance fee and 80% coming to us.
Think of it like this, if they cash flowed out 8, right, you'd pay 20% of 4, so you pay
Right.
an extra 80 basis points.
After all fees and expenses, so it's
Right.
actually cash in our
Exactly.
pocket.
Yeah.
Actually, I understand how the regulated utility has an assured profit, basically. How does the owner of we'll be owning the assets that the regulated utility uses, how are we protected against inflation and all of that?
Well, it's passed through in a couple of different ways. The first is through the cost of debt. So there's a regulated return that has a cost of debt component to that. And so as rates increase and inflation increases and rates increase, that regulated return increases. And so that's the and then should I move maybe to the no. The regulator sets sets the revenue based on, the cost of debt, what it assumes that it's going to cost to maintain the asset and upgrade the asset, any upgrades they want. Also, what they think the cost of debt will be, which also increases as rates increase. And they pass through through that revenue what inflation is, and that's through the rate charged to the end users. So there's two protections. One is the rate that's the rate that's charged to the end user comes through the revenues, but also through that cost of debt.
From our point of view, though.
Or that
the end
regulated
user is the
return, sorry.
utility itself, correct?
Sorry?
From our point of view, is the owner of the underlying asset, our end user is the regulated utility.
The end user would be the person who turns on the water, in this case.
Reynolds, this is owning the utility.
Oh, so we're owning the utility.
Right,
We're owning
the actual
asset,
utility.
we're owning
Jargon
the
that I
utility.
just
Okay.
realized is the
Right,
problem.
okay. Did that clear it
We're
up?
referring to each individual company as the asset.
Okay.
And I understand where sorry.
Right, sorry about that.
the
So
confusion.
the end user would be the person, who pays the bill, who flips on
Okay.
the light switch and turns on the
Now
water.
I understand.
Okay.
I just didn't, I misunderstood our role, I'm sorry.
Ashley,
Yes.
has there been any research done on, has there traditionally been any gaps between what a European regulator deems as appropriate cost and what we would deem as appropriate projected cost to run
For-
the system? In other words, the European regulators are setting the rates based on what their estimates and reasonings are for cost of running it, right? Has there been a traditional gap between what that figure would be and what we might deem as reasonable?
Well, it actually works in the favor, and it typically has worked in the favor of the investor. And so, we just saw from kind of the Value Bridge framework, there are levers to actually outperform that return. And if the regulator sets a return that is too low, because think about their entire purpose of existence is to make sure that when you turn on your water spigot, it's going to come on, first of all, and that it is of good quality, and that the end user is not having to pay an exorbitant amount for that. And so they're actually incentivized to set the rate that would allow the investor, that would incentivize the investor to make sure that happens. And so setting it low can happen in short periods of time. That's some of the regulatory risks that we'll discuss going forward. But really, that happening over long periods of time will affect the asset and affect the quality that the user receives and really isn't sustainable.
Mr. Hancock, if I could add, in the opinion of Macquarie, who is the manager of this strategy, Europe presents a much more long-standing, well-understood regulatory regime, and that is consistently recognized the need to have the investors earn an appropriate rate of return. So, and that's not as well defined and understood broadly in the United States as it is in Europe.
Well,
So
you understand the concern that calls the question is.
Oh, sure.
Is our investment or the performance of it at the mercy of, and I'll put air quotes on, a European regulator?
Sure.
Sometimes those folks have a very different lens of viewing things than we traditionally do.
Their track record is in the eyes of Macquarie a more robust and reliable track record than North America right now.
Okay, that's what I was looking for,
so,
Jeff,
yeah.
thank you.
And the assets are cheaper in Europe.
I just want to clarify one thing that's been talked about, maybe I just don't get it. We may invest in Macquarie Super Core Fund.
Right.
What does Macquarie Super Core Fund own? Does it own the assets of all kind of different utilities, or does that own an interest in separate companies that own the assets?
We have an example coming, if specific example of an investment that Macquarie, their European infrastructure team has made. Do you want to just skip to that?
Should I skip to that?
Yeah,
Sure.
let's, and I think that this may be answering the questions, we just saved it too long.
Okay.
Yeah, so let's move that forward. So here's Thames Water, as Jeff just mentioned. It's the largest water and wastewater company in the UK. It services about 25% of the population of England and Wales. Macquarie owned this asset from December of 2006 until May of 2017.
What do you mean, but this asset, that's, I
So
don't
it's
know
a
what
water
this asset
distribu,
is.
so it's water distribution. So
They own the
So it
company.
owns the
They
pipes?
own the company.
It owns the pipes, or does it own a company?
it owns a company.
Okay, that's
That's
what I'm
the-
trying to get to.
is that the root of the
What do
question?
they own?
Right, they own a company that is charged with maintaining and operating and distributing the water to the service, to
Okay.
the end users.
Okay, great.
Okay.
You know, they're the sole owner of the.
So in this case, it was and particularly as this was as you kind of go back and there wasn't as much capital in the asset class, it wasn't uncommon for different investors to go together, form a consortium, and invest in an asset together. We do see more now as kind of the funds are larger, there's more capital in the market, that, that there'll be one, either investor taking out the entire asset or one large lead investor with maybe some of the smaller sovereign wealth funds, the Canadian plans kind of attaching on and providing extra capital. So in this case, there was a consortium. Macquarie was the primary investor in that consortium, but there were other owners.
Do they have rules about how big a fish they want to be in the pond?
Enough to make sure that they have control and so that they can affect the operations of the business.
I'm going to propose a change in our nomenclature. Instead of asset, we're going to start saying company.
Yeah, okay.
I will try.
Thank you.
I will really, really try. So Macquarie did, as I said, own the asset, December of 2000. Company. I try, I said try. It's been hammered into my head. It is. I feel like maybe you should need some shock therapy. Every time I say it, I get a little buzz. So until May of 2017. And Reynolds, I think this gets to some of your question. As we see on the bottom left, represented by the blue line, that's the regulated return for UK water assets during their period of ownership, which ranged from 7.7 to 5.7%, as we see here. And then the regulated return is comprised of several factors. One of those is the cost of debt. And so on this chart, I'm also showing the UK interest rates. That's represented by the green line, which actually during this period decreased more than the regulated return did over the period of ownership. And so even while the regulated return and interest rates were declining, Macquarie was able to earn a return of 12% on the equity investment of Thames Water. And so the regulated return represents the return for the entire asset, both the equity and the debt. And so we've talked a lot, about the essential nature of the assets and how that provides demand stability and reliability of return. That demand stability also means that the assets can sustain more debt on the companies than you would typically find in a more cyclical business. So for example, at exit, Thames Water had a debt ratio of about 70%. And so while this is higher than we are used to seeing, we can take comfort that even at these leverage levels, these assets maintain an investment grade rating. And Macquarie is committed to only using leverage on the companies in the portfolio to the extent that they will maintain that investment grade rating. And this is using the framework that I showed at the beginning of the presentation, and this is the attribution of Macquarie's performance for Thames Water. So as I just discussed, a portion of the performance over the regulated return can be attributed to holding more leverage than the regulator assumed. But as we discussed at the beginning of this presentation, Macquarie also has levers for achieving outperformance over that return. So Macquarie more than doubled the asset base during its ownership. The network still had wooden and brick pipes from the early 1800s that had to be replaced. They upgraded and expanded the sewage treatment facilities. They built a significant tunnel that was to prevent runoff and sewage from ending up in the Lee and Thames rivers. And we see that represented here by the first box on the slide. And so as we move out, we can see the value that was created from operational efficiencies. This was a carve-out asset, so Macquarie had to replace the management team and build standalone and treasury and finance functions. They were able to, through some of the improvements to the asset, improve leakage, water quality, and customer service, which are tenets that the regulator sets out and expectations, and they're able to get rewarded for that. And that's captured by the box there. And then finally, we see the value that was added through creating a debt package with a service cost below the debt, the cost of debt allowance that the regulator determined. And that's captured on the framework there. So all of these things are able to add up to substantial outperformance versus the regulated return, which we saw on the prior slide.
Is there a possibility that a regulator will in essence punish a well-performing entity, utility here because of its outperformance,
So-
and hence not let them charge as much money?
So it is a little bit of a balancing act. So the regulated return is determined in what is called a rate case. And so it's a negotiation that lasts, basically as you wind up one rate case, you start negotiating the next. A regulation period is about 5 to 7 years based on kind of the jurisdiction we're talking about. And so if you outperform, so they give you a budget, for example, for what they think it should cost to operate. And so by this framework, they say it costs 10, the manager can do it for 8, they get to keep 2. But to your point, if the regulator gives them 10 and they come in and do it for 4, the regulator's probably not going to allow them in the next period to keep, to set it to 10 to allow them to continue keeping the 6. Right. So they will say, okay, well, you've proven that you can operate this more efficiently, so here's your new budget, and it's lower than what we previously, this time we're going to give you 8. So there is a little bit of a balancing act as you kind of go through these rate cases, and it's a lot of negotiation, which is actually a big value add that's not necessarily picked up by this framework, is their relationships with the regulators and their ability to negotiate that through the rate case.
Mr. Condon, I think you've made a very important observation that gets right to the heart of why this is attractive. This is not, we are not going to wake up and learn that this fund investment is earning 18%, because that's the effective regulation is going to put a ceiling in place on that return over time. But neither do I believe we are going to wake up and have this earning 2%. The goal of the regulator is to allow the capital to earn what is referred to as a fair rate of return. And that is, there's some wiggle room around that where the manager can do a little bit better and we can benefit from that. But, so I think of the regulated utility space as an opportunity to earn a return that looks attractive and has a high utility function for us because of what we need to earn. And it is not going to deviate meaningfully from that over longer periods of time. So, ceiling and a floor.
Right. So does anyone have questions about this? Because I can go back and kind of pick up some of the other key points about the investment if we'd like to move on. Okay. I'm going to move backwards a little bit. And so, I think this is where we were. So here I have outlined what the rationale that really makes this investment a good fit for our infrastructure portfolio. And first and foremost is the experienced team that's going to be managing the fund. Macquarie has the largest and the most experienced infrastructure team in the market. There are 28 director-level employees with utility experience that are going to be working on the fund. They're going to be supported by more than 70 analysts who work across the Macquarie's European platform. And they also have the support of the entire Macquarie organization, which is about 450 infrastructure professionals globally. So a very robust team with a lot of experience to manage these types of assets. We also liked that the asset characteristics match the goals of our infrastructure allocation. So our infrastructure portfolio has the stated goals of providing inflation protection, providing consistent cash income, diversification, and a stable return. And so due to the essential nature of the assets and the monopolistic characteristics of the fund, a substantial portion of the revenues will be regulated, and they'll have a strong link to both to inflation. And again, since they provide that critical service to the community, there is a stable demand over the cycle, like we saw on a few slides back. So that offers the downside protection that really, we're looking for in these assets. So a portfolio of these companies, should provide a very stable return with a predictable cash distributions that correlate well with rates and inflation. And the third rationale for this investment is Macquarie's disciplined approach to core infrastructure. In response to today's low return environment, it's really become common for a lot of infrastructure managers to take on riskier investments to meet the return expectations that are set out by their strategies. And the fund protects against this in two ways. They create a suitable list of investments that the team can invest in and pursue during the investment period. And also the fund structure protects against the style drift as it is incentivizing yield and not just total return. We've talked some about these, but I did want to outline some of the key risks that we're accepting by making this investment. First, as we've discussed, the regulatory risk that comes with investing in regulated utilities. As with any long-term asset, we had to contemplate what might happen to the returns of the assets in a rising rate environment. We had to look at and get comfortable with the fund's liquidity options as well as the fund's allocation policy. I'm going to stop there and move into performance. The Macquarie's European team has invested in 5 funds. They're going to start raising the 6th this summer. These funds really should be considered more core plus. A few of the assets would even be considered value add. They are not the returns that we should expect to achieve in this strategy. However, I do think that we can take from this Macquarie's capabilities in the space, especially as we move down the slide, we see MEF returns ranked against other infrastructure funds in the Cambridge universe. And you'll note that in some periods, there's not a lot of data, but given that demand stability that we've talked a lot, or given the return stability that we've talked a lot about, it's reasonable to assume that in the years where there's not enough data for Cambridge to construct quartiles, if you look to the year prior and the subsequent years, you can really assess relative returns in that way. And when you do that, all of the Macquarie European funds have ranked in the top half of infrastructure funds on an IRR basis, which is notable considering that not all of these funds would be core. Some of them would be value add, opportunistic, and there's even energy funds included in those. And then on a multiple basis, the MEF funds have consistently ranked in the top quartile, which is likely due to the longer hold time that you get from core infrastructure investments. So as we noted, these returns don't line up exactly with what we should expect from the fund, but it is important to note that Macquarie has invested in over 13 billion euro across 11 utility assets, with a combined IRR of 12.4% and an annual yield of 6.5%. And so with that, I'm in summary, making the recommendation for a 125 million euro commitment to the Macquarie Supercore Infrastructure Fund at the terms outlined on the slide.
One question about
Sure.
liquidity, and I assume we have people who do some analysis with respect to liquidity. How's this 20-year investment fit into any kind of liquidity analysis that we do, or?
This is easily the longest proposed fund term that we've looked at. And again, relating back to my earlier comments, that the assets have this very long life, and that's how we have comfort there. But I mean, it's it is a long fund life, ameliorated in part by the fact that we are expecting this 5+% cash distribution on an annual basis.
Right.
Which, as I sit and think about liquidity, I think about every asset class and how is every asset class going to be able to contribute to the benefit needs of the plan on an annual basis. So when I think liquidity, I think underlying liquidity, and does it match the plan's liquidity needs? And certainly an investment kicking off 5% is doing a tremendous amount of that's tremendously useful against the backdrop of what is our annual net benefit obligation. So that's liquidity is not just lockup. It's what capital is available to you along the way. And if we start with an expectation in kind of a low return environment of 5%, if there's upside, in the case that rates rise and there's additional capital, all the better. But let's not make those types of assumptions.
Okay.
Jeff, that 7%, 8% net return, over what period is that? Will that be over the entire,
I'll defer to Ashley on this.
Ashley?
Yeah, over the fund life.
over the entire?
So that should be the fund.
20-year?
Yeah,
Is that an annualized rate?
Yes.
Yes.
Oh, it's an annualized
Yes.
rate, okay.
May not be.
Otherwise, I would just show myself out.
Yeah. I would think so.
Any other questions for Ashley?
Other questions?
Or discussion? So there is a lengthy motion 7 in your open session motions packet, which I am happy to read, or we could just refer to it if somebody would be willing to move that. Thank you. Is there a second?
Thank you.
Second.
Okay, any further discussion? If not, all in favor?
Aye.
Any opposed?
I oppose this, and with respect to you, great presentation, and y'all have obviously done your due diligence. I really feel that the risk of infrastructure in Europe is as old or older than it is here, and it's crumbling at a faster rate. I think there's gonna have to be a lot more resources sunk into it going forward. I think the cost of financing, sinking those resources into it is going to be higher with higher interest rates. And I honestly don't believe that the regulators will maintain what I call the spread of what an investor is allowed to make. So I think that folks in this investment boat might feel the squeeze. So a very respectful no to this from me.
Thank you. Any abstentions? Okay, so we have it with one opposed.
Thank you, guys.
Thank you very much, Ashley. Should I ask if anyone wants a break, or do you want to move on?
Just break it by, it'd be good.
Okay, would anybody care for a quick break before we move on to the delegated investment report?
Very much so.
Okay, so we will adjourn for, we'll say 5 minutes and
I don't know.
back in 10. Yeah. If you're not interested in returning, 'cause maybe we will anyway.
Can we, please?
Let's see. I think, Jeff, you're still up with the
Yes.
delegated investment report.
Thank you, Madam Chair. Since the last meeting, we have closed on 2 new investments under the delegation policy, both being private equity. I'd like to invite Josh Green, who is already in position, to give us a brief summary of our latest investment with Industry Ventures.
Good morning. As Jeff said, I'm here to give you an overview of Industry Ventures Partnership Holdings Fund 5, which was closed on June 1st. We made a $50 million commitment to this venture capital fund of funds in order to receive broad diversified exposure across stages, sectors, and vintage years of the venture capital market. Industry Ventures utilizes the depth of their team's experience in their broad venture network in order to achieve returns in excess of public markets. They access the venture capital market through 3 avenues. First is primary fund investing. This is basically the same way that we invest in private equity funds through a regular fundraising process. This is the main differentiator in the Partnership Holdings Fund series in previous industry venture funds that we've invested. Their team identified the early stage venture market as one that was underserved by institutional capital and had high return potential. Next is secondary funds. This is buying an interest in a private equity fund from an existing limited partner. They're able to add value here through buying these funds at a discount and having transparency into the underlying portfolio companies. Finally is direct and co-investment. Their team is able to target high conviction companies within the funds that they've invested and get access to those companies either through co-investing and getting overflow capital alongside the fund structure, or going outside of the fund structure and investing directly in the company themselves. This has been a large return driver for the fund. Our team and Alborn has identified Industry Ventures as an important relationship for the private equity portfolio. Not only is it our main access of venture capital, but the 3 investments we've made since 2008 have resulted in 25% IRR. They've been able to achieve this through their experience of investing over the last 17 years through multiple market cycles, through which they've invested in over 275 funds and invested directly in over 240 companies. Overall, we got a conviction that Industry Ventures Partnership Holdings has and will continue to meaningfully outperform public markets. One way to measure this outperformance is through a public market equivalent. This is buying a public index every time there's a capital call and selling that public index every time there's a distribution. So we look at this in terms of excess returns. So the bars here refer to those excess returns of those public indices. Anything positive is outperformance and negative is underperformance. So we compared this to 2 indices. First is our private equity policy benchmark, which is 80% US and 20% international developed plus 300. But we found a more appropriate mix is the blue bar, which is the Russell 2000 or US Small Cap Growth Index. So as you can see, 3 of the 4 Industry Venture Partnership Holdings funds are outperforming the Russell 2000 growth. And while Fund 4 has had some early success, 70% of the portfolio is still being held at cost, while the Russell 2000 growth has achieved an over 30% return since they began investing in 2016. Ultimately, with all of those funds combined, the Partnership Holdings Fund Series has achieved a 500 basis point annualized excess return over public markets. We took this a step further, aggregated all of the realized investments, and then segmented them by investment type. So again, still thinking in excess return terms, there are 2 main takeaways from this slide. First is that all investment strategies are outperforming the Russell 2000 growth, as designated by the green bars. And second, direct and co-investment have been the highest performers, meaning their team's ability to go in and invest in the companies that are these funds' best ideas has been a meaningful return driver.
Can you go back to the previous slide? I have
Yes.
one question. One more.
Sure.
Okay, so it's had the years down at the bottom. I wanted to see over what time frame. So that analysis goes really all the way back to 2006.
It does.
There's been really overperformance since 2006.
Yes.
Okay, thank you.
Yeah, sure. So overall, Industry Ventures is a relationship that we value and one that we have a high conviction in as a partner. We believe the Partnership Holdings Fund Series has and will continue to outperform public markets due to the depth of their team's experience and their broad venture network. Are there any questions?
Thank you, Josh.
Thanks.
The next investment, there he is. The next investment we will review just closed earlier this week, and I'm going to ask Derek Connor to walk us through the Providence Strategic Growth Fund.
Thank you, Jeff. Good morning. I'm here to talk about a recent investment in Providence Strategic Growth 3, also known as PSG3, as I'll refer to it throughout the presentation. We recently closed this investment, actually last Tuesday. We made a $75 million investment in PSG3. The strategy of the fund is to invest in growth equity in lower middle market companies in the software sector. In terms of the size of companies they're targeting, it's smaller businesses, typically between $10 million to $200 million of enterprise value. The sweet spot for PSG is between 40 to 60 million. Typically, these are businesses that haven't had institutional capital. There's less competition. In the private equity market, once you go above $200 million of enterprise value, that's where you typically see a lot more auctions and competition for assets. So we think this is a relatively underpenetrated area of the market that Providence can execute on. One of the things that got us excited about the opportunity is the macro opportunity. Just looking at the rapid growth that we've seen in data, cloud computing, and the proliferation of mobile devices, this really benefits the strategy of PSG. In terms of their approach, they typically create platform companies, software companies, and they achieve scale through growing revenue organically and also finding competitors, smaller competitors in these sectors and achieving rapid scale. And the strategy for exit is to eventually grow the companies to a large enough size where they sell it to larger strategic acquirers or private equity funds. If you look at the amount of capital that's been raised in private equity funds focused on technology, there's a lot of capital out there, and PSG has actually sold 3 of their businesses to these private equity funds. So we think that's a pretty attractive opportunity for exit. PSG targets 4 themes, which is outlined in the chart: security and network technology, mobile payments, business applications, and artificial intelligence, which has been a growing industry over the last 3 years with a lot of capital chasing deals. PSG is a new relationship to RSIC. From a portfolio fit perspective, we view the strategy as attractive. Growth equity is an underrepresented area of our portfolio. We're currently below our target allocation. The firm was founded in 2013, and PSG is an affiliate of a larger private equity firm called Providence Equity Partners, which is a private equity manager with about $50 billion of assets. They're focused on technology, media, telecommunications, and education. And we think one of the key differentiators for PSG is having access to the broader Providence platform. They have a deep team of partners that have relationships with a lot of the CEOs and executives in technology companies, and they've actually funneled some deals to the PSG team. So we think that's pretty attractive. Over time, they've invested approximately $1.3 billion of capital in 25 companies, and they've executed 89 add-on acquisitions. They have a team of 24 professionals, very relationship-driven. They target the 4 themes that I talked about and really try to identify the companies in those particular themes to go after and pursue. Performance has been very strong. Both Fund 1 and Fund 2 are top quartile. PSG 1 has a net IRR of 89%, and PSG 2 has a 59% IRR. Going to the next slide, similar to what Josh showed earlier for Industry Ventures, what we have here is a comparison of Fund 1, Fund 2, and then the combined funds versus 3 public equity benchmarks. We have the Russell 2000 benchmark, our private equity policy benchmark, and then lastly, the S&P 600 software index, which we feel is the most appropriate benchmark given their strategy of focusing on North America software companies. And as you can see, both funds have achieved significant excess returns over public markets. Then the last slide, just a reminder, we're investing $75 million in PSG. The deal closed this past Tuesday, and importantly, we do have a seat on the advisory committee. And with that, happy to open up to any questions that folks may have.
Just one question. You said that they have a history of selling some of their investments to other private equity firms?
Yes.
I assume those are unrelated to private equity firms, or
That's
are they
correct.
related?
Unrelated, yeah. So, they've sold 3 of their businesses to 3 different tech-focused private equity firms. And, these are larger funds that have a lot of capital to invest. So once they're able to scale companies to a sufficient size, it becomes attractive takeover targets for many of these private equity funds.
Okay, thank you.
Mm-hmm.
What does PSG actually do? You said they created a platform. Does that mean they acquire several companies and
Yeah, so
put them together?
they'll find a company, they'll identify a company that's going to serve as the platform, and they'll use that company to consolidate by buying other companies in industries, or it could be related industries where they want to potentially expand into new markets and new areas. One example is an investment they made in a company called Ministry Brands. This is a software company that really serves faith-based organizations, and they expanded by buying smaller businesses kind of in that community, and then eventually expanding to other areas such as sports. So typically it's finding a platform company and then consolidating by purchasing other companies and rapidly growing the businesses.
Yeah, I read the write-up about Ministry. That's typical of the
Yes.
of the kind of thing they like.
Exactly.
Okay.
Yeah.
Can you explain just how does that carried interest work? 20%.
Yeah, so the carried interest is 20%. We have a preferred return of 8%. So if the fund achieves a deal greater than 8%, then their general partners can entitled to 20% of the overall profits, and there's a waterfall mechanism that flows through.
The system has detected that this conference has reached a duration limit for 3 or fewer participants and will now attempt to close the conference. If you wish to remain in conference, please press any key now.
All but perfectly timed. questions? Thank you, Derek. That concludes the delegated investment report. Madam Chair?
Okay, thank you. I think next on the agenda is executive session. So if there is a motion to recede into executive session to discuss investment matters pursuant to a few SC codes, as you can reference in motion 8 of the open section. Would someone like to move that?
I'll make that motion.
Second?
Second.
Okay, all in favor?
Aye.
Okay. So we are now officially be in executive session.